Welcome guys to the new Candlesticks and Indicators tutorial series. We'll begin this series discussing candlesticks and how to use them. So regarding candlesticks, we'll have two videos. This will be a two-video tutorial. The first one will discuss the basics of candlesticks and the most common patterns. And in the second one, we'll go through the charts and see how candlesticks can be used for live trading. Alright, let's begin. So for most of the experienced guys, this is basic knowledge. Feel free to skip through it. For the guys who have never seen a candlestick before, it looks like this. They can either be green or red. Green simply means that the price closed higher than where it opened. One thing I should mention, a candlestick describes the price action in a specific period of time. So let's say if you're looking at a daily chart, one candlestick will represent the price action for one day. If you're looking at an hourly chart, then one candlestick will represent the price action for 1 hour. So in this case, let's assume this is a daily candlestick. All this green color shows is that the price closed the day higher than where it opened. At the top was the high of the day, that's the highest price of the day, and then the low of the day. A candlestick, you have the thick part, which is called the body, and then these thin lines, which are called the wick. Should be pretty straightforward. Let's move to the most common types of candlesticks. So these are the most common types of candlesticks, or at least the ones we need to use. So this one, for example, the first one, you guys can see it's called momentum candles. The reason they're called momentum candles is they have a long body and small wicks. So in this case, it's pretty clear that price has strength. Whatever direction it's going, whether it's up or down, it's moving strongly. So either the buyers are in control or the sellers are in control. There is momentum. And it's pretty clear what the market wants with these candles. When these candles appear, you know what direction the market is heading in. And then you have the second type of candles, which have long wicks and a small body. So in this case, let's say the price opened, it tried to go up, could not, was pulled back, then it tried to go lower, could not, pulled back, and closed somewhere near the open. This type of candle is called indecision candle. That's because neither buyers nor sellers are in control. So the market has not really decided what it wants to do. The third type of candles are called rejection candles. Rejection candles form when the market starts moving in one direction, but in the middle of the action, the people that were in control of the market lose control, and then the market reverses. So in this case, for example, at first price tried to sell off, so the sellers were in control. And then at some point they lost momentum, they lost control, and buyers came in the picture and then pushed the price higher, and it ended up closing green. The reverse happened with this one. So these kind of candles are called rejection candles, and it just shows that one side, either the buyers or sellers, failed during the action this time. So in this case, when the candle closes green, the sellers failed somewhere midway and let the buyers come back into the action. Vice versa for this one. So these are the main types of candles, and each one obviously is giving us a specific kind of information. The first one is saying that either the buyers or the sellers are in complete control of the market. The second one is saying buyers and sellers are fighting. We don't know which side will win. Right now they're equally matched. The third one is saying that at one point, one side was in control, but it lost its way somewhere in the middle of the action, and then the other side took control. So the story these candles present is what we need to focus on. So what happens is, most of the times when people try to learn candlesticks, they will try and memorize a lot of patterns. And that's not really how I use it. If you want to do that, go ahead. The way I like to use candlesticks is to understand the bigger picture, to understand the markets or what they're trying to do. So in this case, I have the most common patterns on this chart, and I will go through them one by one and try and explain how I think of them and see if that works for you. If not, you can always memorize all the different patterns and try to look for them. So the first one is called bullish engulfing. The bullish engulfing, the story this is telling me is that price was heading lower. You see the previous candlesticks, the sellers were in control. And then at this point, the next candle, the buyers came back in the picture and they were stronger than how strong the sellers were. So initially sellers were in control. They tried to push the price lower, but buyers didn't let them. And the buyers took the price up such that it negated the entire action of the previous candle. That's why it's called bullish engulfing, because it's green and it engulfs the previous candle. So this kind of candle you will usually see during reversals. Let's say price is going lower and at some point the sellers lose control and you have this big green candle at some form of support that engulfs the previous candle. That shows that now buyers are in control of the market. You have this morning star pattern, again a reversal pattern. You can see initially the sellers are in full control with the momentum candle. Then we have an indecision candle. What does this tell us? That now sellers are not in full control. There's actually a fight between buyers and sellers and there's no decision. And then you have this big green candle. It shows that after this indecision, buyers won the fight, in which case price is now likely to go higher. So it's called a morning star pattern, but you can see these three candles told you a story and it showed you how the market environment has changed. And that's how I like to look at candlesticks. I don't really remember the patterns names most of the times, and there are too many of them to remember anyways. A bullish pin bar candle. A pin bar candle is the rejection candle we discussed. In this one, you can see initially the sellers were in full control, but at some point they lost control. The buyers were able to push the price back up quite a bit. Now sometimes the buyers can push it up and finish green. Other times maybe it finishes slightly red. But overall there's a long wick and a small body. And this kind of candle is called pin bar. The reason this one is bullish is because the sellers had control and then they gave up control to the buyers, and the buyers ended up with control after this action is over. The vice versa, the reverse of this is the bearish. You have the buyers have control and at some point they give up control. By the time the candle time frame is over, the sellers are in control of the action. So you can see the top one's a bullish pattern, the bottom one's a bearish pattern. We'll go through them one by one so it will become obvious how. This one is called bullish harami. Now this one, I'm not always trusting of this being bullish. What I like to call this is an inside candle. Now usually when this candle is red, and if the inside candle was red, that would ideally lead to a continuation down. That's called an inside day. That ideally leads to a continuation down. But if you have a big red candle where sellers are in control and you have a green inside candle, that increases the chances that we might reverse. So as I said, I don't like to call it bullish or bearish harami. I just like to call it as an inside day, because I still keep in mind that maybe this control of buyers, it could be on low volume. It could be on just lack of action. So here we have sellers in complete control. Here buyers gained control, but they could not break it out yet. So we just have to keep in mind that this is still an inside day. It can go up or down. Obviously the chances of up increase once this inside day is green. Now bearish engulfing, the opposite story of what we had with bullish engulfing. You have buyers in control and at some point they lose control. You have bears print a momentum candle that engulfs the previous candle, aka the bears gain control at this point. By the way guys, I use bears and sellers interchangeably, same for bulls and buyers. I hope that should be obvious. Evening star pattern, you have the buyers in control with a good momentum candle. Then the next candle shows some indecision, aka buyers are losing control now. Now there's a fight between buyers and sellers. And then the sellers print a strong momentum candles, aka they have gained control now and the market is bearish. Again, a reversal pattern probably at the end of a trend. Already discussed bearish pin bar. During this action, at some point buyers were in control, they lost control, and then by the end of the action, sellers had control. Another rejection or reversal pattern. Bearish harami, as I discussed with bullish harami, it's simply an inside day to me. Yes, it looks like that the sellers gained control at the end of it, but I always keep a sense of doubt about the inside days. That's about it, guys. This is what I wanted to discuss, that I don't try and memorize these patterns. As I said, I shared the story of each of these patterns and how it should be common sense of what they're trying to represent. Now in the next video, we'll go look at the charts and see how to use candlesticks in the overall picture.